Happy Wednesday. How you doing out there? Good? So weird. I can't, you guys aren't talking back. I see your shtick going on in the chat there, but otherwise it's like, you know how weird it is to just talk to a camera? I'm going to talk to Cody for a second. How you doing over there?
I'm doing great. How are you?
I'm doing very good. Thank you for asking.
Thanks.
Yeah. I want to give you the same question I gave to Eric yesterday. $3,000, you let me slap you in the face. And then, of course, you can slap me. But if you knock me out or I lose, you get another 3,000. You in?
Yeah.
You would do it?
100%.
So I'm having second thoughts after Doug talked about it, getting some teeth knocked out and stuff.
$6,000?
Actually, I'll throw it out there. I had a client email me that saw what I asked Eric and said, Dustin, if you can create my retirement plan so that I end up with an extra 3,000, I'll spend it on slapping you in the face.
Oh, wow.
I was like, okay.
So you do it for 3. Was that your answer?
Oh, I'll commit to that. Yeah. So I was like, I'll try to find 3 extra thousand in your whole retirement plan.
We should figure out the low number. We should one day. Would you do it for 2, 1?
Yeah, that's true.
But anyway.
No, I'm pretty hard at 3 though.
Oh, okay.
You?
I'd do half. Yeah.
You do 1,500?
Yeah.
Oh, hell, I might just do that.
I'm in. Let's do it.
Okay, 1,500 to slap Cody. Not bad. You can't slap me back though. I want 1,500. I'll call it, say like on 2, full rules. You hold the thing for $1,500. I can just have at it.
For one swing? Yeah.
One swing. Okay. Hey, everybody will do something for $1, right? Just name your price. Now that we got that out of the way, I was just curious. Welcome to the Closing Beat. We are financial advisors here at Jazz Wealth. We just, why not have a good time with it? Retirement, investing, finance. It can be a little bit boring, and I try to make it interesting while teaching at the same time, so I hope you like that. We also have a free form you can have, and you're going to see this is not like to capture your email and like pick on you and stuff. If you go to jazzwealth.com/2023, we just laid out all the numbers. Haley will email it to you. It's totally manual. This is not like an email capture thing, but if you want to know tax brackets, IRMA rules, your IRA contributions, we just put every single thing on there. It's 2 pages. You're welcome to have it. It's free. We won't bug you. We won't sell your information. And once you see how we go about sending it to you, you realize, okay, these guys are just giving us something here for free. It genuinely is for free. Anyways, hey, as I mentioned in the notes from Jazz this week to clients, that's a weekly email that I physically type out for clients. There was a lot of real estate econ news coming out, and well, I couldn't stop it, so it's coming out there. A couple things made the headlines. I'll just point out here, because if you're in that home builder kind of space, or you're looking for real estate, or you're playing that game, you may be interested in this. Mortgage applications, the amount of people that said I would like to apply to pre-qualify for get pre-qualified for a mortgage, it's down quite a bit. We actually just broke this low. And so I think that's probably why it grabbed a little more attention. If you look back, that just puts you all the way back to 1994 since the last time we've been to these lows here. So mortgage applications rather rapidly falling off a cliff. If we take it a little bit further and get some more data for you, this is not mine. This just came out today. Mortgage purchase applications, in other words, when you sign a contract to hopefully buy the house, those are down as well. That's your blue line here. That's made a new low. I could only go back to 2017 for you on that one. And then new and existing home sales, just think of that as a closing. So somebody physically went to closing, got the keys, and the job was done. That's also not looking really good. So the housing market has no doubt steeply pulled back there. But one thing I would point out is it seems to be kind of leveling off. People like it down here. So new applications down to about 170,000. New existing home sales about 4.6 million. I forget the exact number, but there's the data for you if you want to check out that, and hopefully gets you thinking just a little bit about, is Dave Ramsey right? Has this been the best time to buy real estate? A little bit tricky there. The Dow, let's start here, down 4.2% for the month of February, back to the 200-day, back to price support. We already talked about this yesterday. A little bit of love today, which is good, right? Just kind of broke through that support, looking at the 200-day moving average, and people said, okay, that's good enough. I like that 4.2% decline. And so obviously the Dow, a performer today, was able to finish positive, and not bad. Good technical location if you like that sort of thing, and that's about all you have to go on for right now. The S&P lost 2.6% in February, and really that hasn't changed. Nothing really changed today. Today's performance is representative of a indecision bar, candlestick, whatever you want to call it, and still up 3.4% year to date. All that pullback came through February. So January up, February down. That's exactly what we've got for the moment. Now, earnings season's basically over. Over 92% of the S&P has reported now. 68% of companies in the S&P have beat on earnings. Remember, whenever somebody gives you a stat, you say, okay, is that good? Is that bad? Is that odd? What is it? 77% beat rate is the average. So earnings beat rates are quite low, and you would think that helps the market or individual stocks start to pull back, and it has largely. But I ask you, is the market cheap here? And remember, cheap has to do with valuation. So I get it that it's pulled back, but is the market a good value? Fundamentally speaking, is a good value to invest in the stock market? One way you look at that is your PE ratios, or you look at the earnings rate. You can call it whatever you want, but it's the same thing. So typically, the stock market trades, its average range, actual number, is 17 times earnings. So this is typical Shark Tank stuff here. If you're, you know how they go and say, I'm asking for $1 million for 10% stake in my company. Then they get down to the earnings and they go, so you want me to pay 10 times earnings? And you know how they pick on each other for that? Well, the S&P commands an average of 17 times earnings if you want to participate. In other words, the growth of all the companies together represents 17 times the earnings that have been generated by those companies. The current earnings are at 17.7. So you are paying just above average still for the stock market. And so there is an argument to be made that the market is still not cheap here. It is volatile, but it is not cheap. And so if you're waiting for more of a discount, I don't blame you. I'm going to go on to one other thing, and then I'm going to come back to that here for a second. So that's the S&P. Oh, if you look around in the S&P here today, almost every sector was down on the day. Energy was your big mover. Oil with a slight bounce, getting a little bit of momentum. And remember, energy has been one of the more oversold sectors in the market. So a little bit of a bounce today. You like that it erased most of yesterday because that was kind of a negative day. That's okay. It's not an official 180 as the technical traders would call it, but that's not bad. Pretty much every stock in the S&P that was at the top of the performance list today is going to be from energy. You got Valero, Freeport, Phillips 66, Marathon, EOG. All of these are the top performers. There's just, in fact, the first company that's not energy related that is in the S&P at the top of the list is Caterpillar. Yep, 3.8%, followed by Win, right? But other than that, it's just an energy-dominated list here today, so something to keep in mind. If we look at the NASDAQ here real quick, this one only down 1.1% for February. Today, I don't have a lot to give to you. It wasn't a very active day for the NASDAQ either, slight down day. It is still the best performer year to date. However, it's no longer up double digits. It's only up 9.13% for the year. Now, I would like to just use this as our lesson for the day. If I told you you could average over the last 30 years, I had an investment for you, and you could average a 12.7% return, would you take it? And I'll let the stream catch up for a second. Is that interesting to you? Right now, it might sound really interesting, actually. I said not every year, of course, but over the 30-year time frame, you will have a 12.7% return. Is the answer yes, Dustin, I will invest in that, or I have more questions, Dustin? What if I told you that you could have a 12.7% average return, however, at any given point throughout the year, you may be down 50% or up 50%. I can't tell you which one it is, but one of them is definitely going to happen each year, sometimes both. Would you still do it? You see where I'm going with this? So 12.7% is the average return, but I have to suffer through a 50% downturn? I think I would rather have 8% and suffer a 5% downturn there, right? So you don't want to ignore that volatility. Tonight's Jazz After Dark class is going to be why my dividend fund will beat yours all day long. And I don't mean that egotistically. I'm going to teach you as well. So I'm not trying to say that, but we're going to go over that. What should you look for there when you're looking at things like that? Now, to come back to what we're talking about right now, I can say that over the last 30 years, the stock market has in fact returned. I forgot to put 2022 in there. This is my fault. So take out 2022. It has averaged a 12.7% return. Now, remember what we just came out of. There was nowhere else to put your money. You had to put it in the stock market. Remember that? Bonds were nothing. The total return was negative. So I wanted to put that together for you and show you, if you're going to invest in the stock market going forward, in particular the S&P, what range of returns do you have to sit through in order to earn the 12.7%? Are you ready, folks? Good answer, by the way. Yeah. Good answer. Yeah, you guys are saying, hey, I've got more questions. Depends on the risk. Risk can be determined by volatility, or it could be defined by volatility, so I don't mind that at all. Here is the yearly returns of the S&P, and then I went and plucked out their max drawdown for the year. In other words, how far down did it go before it returned X, whatever that is. So, this stinking thing. I'll move this over. You got to be able to see this better. This is good stuff. Okay, that's my fault. I'm sorry. All right, so, for example, handpick a year. I'm going to spin it around and stop. 1998. 28% was the return. That's beautiful. But you had to suffer from a 20% drop in the middle of the year. Now, remember, the average return is 12.7% at the bottom. Average drawdown's 14%. So this wasn't quite one for one, but you had to sit through that. Look at a year where you lost 22%, but you had to sit through a drop of 33.8%. I actually remember that vividly there. So as I'm trying to point out, you gained 11%, but you had to at one point be down 10%. Not negative from your entry point, but the market had to have fallen 10%. The main takeaway from this is the average range in the market over the course of a year is 26.8%. That's only over the last 30 years. Of course, this number changes if you want to cherry pick the years. I just did 30, got tired of digging through all the data. We could do 50 another time. We could do, more after that. Look at the bottom. In order to average double-digit returns, you have to be able to withstand double-digit declines. And it's not quite one for one, but that's where we stand. So think about that. Is that fair? In order to make 12%, I've got to be willing to accept 14% max drawdowns and a 26% total range from the highs to the lows. That's not that bad, right? And really, what other choice do you have? If you say you're going to invest in the S&P, that's what you get. So I wanted to point that out because we're going to go through this year and we're going to see this throughout the year. This will be a great year to highlight the range between the highs and the lows. In fact, you could use the options market to see what the people think it is right now. But we're going to take a look at that. And you've got to be willing to say, I'm willing to handle that double-digit decline in order to participate in that longer-term return. The NASDAQ is even worse, meaning the volatility that you have to accept in order to get those returns is greater. The Russell 2000 is a little bit worse. The Dow is not quite as worse, right? So think about those things. And tonight I'm going to expand on that where we say, well, what's our focus? Maybe it's not the S&P. Our focus is a dividend-based product. We're older, we're retired, we have lots of money now. We don't want that volatility. How do we structure something to make sure that that is not as volatile, but has the highest potential return? That's really our job here is, could we invest in anything and share in the good years with you and then just tell you something about the bad years? Sure, but I don't want the phone to ring every day that the market goes up 1 or 2%. So my job is to build portfolios that have the greatest upside potential, but the least amount of volatility. And my target is always to beat what the S&P is doing. So it's not just about returns, it's about the volatility that you have to accept in the meantime. Because everybody says, I can accept the volatility, man, until it actually happens, right? Come on, I got you there. Hey, did anybody see the Investor Day from Tesla? I didn't. I'm sorry. I missed the whole thing. Did they announce a new car? Today is the Investor Day for Tesla, and I didn't catch any of it. Got distracted there. So I take it there was not a new car. Cutting vehicle assembly costs. I I guess there was no new car. Somebody let me know if there was a car there, but that stock was in the news today. I just honestly missed it, so I won't even pretend like I knew what's going on. Ross Stores, Ross Dress for Less. Remember when it used to be called that? Better than expected earnings. They lowered their guidance going forward. Sales were up 1%. Margins, this is why this thing did, managed to shake off the decline there. Margins up a little bit, 0.5% to be exact there. Full year guidance just a little bit light. That was the problem there that kicked things off. But people said, well, you're going to sell a little bit less, but your margins, if you can keep that going, we're happy. First Solar, there you go. They lost a lot less than expected. So First Solar, previous quarter lost 46 cents a share. Prior to that, 41. They only lost 7 cents a share. They are firing up that Ohio factory. Actually, any day now, it will be up and running. They said by this quarter, it will be up and running to get that Inflation Reduction Act money. If you're a client or a research member, we talked about this, that Inflation Reduction Act money, specifically how they get paid per watt and per production. So really cool there. That production should start any day. And maybe, that might have started today. They might have said something today. No, just a billion different upgrades on that stock. So everybody's excited about that space, as they probably should be. People that are not excited about a stock is this Rivian. So Rivian, now they have a history of not delivering the vehicles that they say they're going to deliver. That history continues, apparently. They guided for 20% less vehicles delivered than what they had previously promised. They are having issues scaling production. And these are their words, not mine. I'm stealing this right from the transcripts there. 2022 production was only 40% of initial guidance of 25,000 cars, and we're already cutting that production by more than 25% going forward. Sorry, I said 20 a second ago. They're struggling, man. Stock basically hit new lows there. Not a good spot for them. Monster, going to do a 2-for-1 split here. They reported earnings better than expected. Everything's good there, other than a lot of times when you're doing a 2-for-1 split, you do see a temporary drop in the stock, and I believe that did happen today, actually. And then Qualcomm, I find this interesting. This is kind of a stock in the news thing. Qualcomm, the CEO came out today. He goes, we expect Apple to use their own modems in their iPhones starting next year. And this was kind of in the middle of a sentence. He didn't just voluntarily throw that out there. We expect Apple to use its own modems in iPhones starting next year. How do you think, first of all, he expects that? No, that's actually going to happen. Where does he get his data from? Look, Tim Cook. Like, you think they don't talk? So the fact that he says that commits Apple now, we now know that Apple's going to use its own modems in their iPhones starting next year. So that was that CEO basically spilling the beans on that one for them today. And yikes, right? I don't think it's a good thing for Apple, by the way, but we'll see what happens. Hey, Jazz After Dark here tonight. We're going to talk about we did the 100% chance of recession. Tonight, we're actually going to do the data behind the markets and recession. So we're going to look at the last couple recessions. We're going to look at how the stock market responded during the recession. I got a few points to make there with you, make you a little bit smarter, a little bit brighter. And then tomorrow night, we're going to do why my dividend fund will beat yours all day long, something like that. But I'll show you why. We'll go through the details of it there so you can learn a little bit. Dividend funds and investing for dividends or interest right now is really popular because you're getting paid a fair amount. Before there really wasn't much money there. So we're going to go over some key considerations there. All right, I'll take your questions if you have any, and then I'm going to get on out of here. And let's see if this works again. Works just perfectly. I love it. What are the details of the Bollinger Bands? Are they on there? Oh, they are on there. I don't know. Oh, 2 standard deviations. Yeah, it's just whatever came on the chart. I didn't make that happen. Tesla building a car called Juniper. Oh, cool. Is that the cheap one that's under the 30,000? All right, I'll have to check it out. I meant to take a look at that. Day got away from me. Yeah. Worst financial decision in your life? You bought 5,000. Ooh, $100 a share. It might be a while till you get back there. I hope they figure out their production because I love competition. I think there should be a lot of competition. It means that we benefit, but they are not looking too competitive right now. Yeah, housing data clearly shows the Fed is winning. Paul, yes. Why do you think Wien is outpacing the sector, and will it continue? It's outpacing because they're getting the dollars right now. Their comments on Macau and Macau opening and the Chinese going back and gambling there, they're full steam ahead there. Remember when their earnings came out, we talked about their average revenue per available room, double, right? Vacancies next to nothing. Yeah. Love it. What do you think of LTC for a REIT at these levels? What does that mean? Is it a short-term idea? Is it an investment? Clearly an overextended stock at this point, but I don't know much about your time frame. Yeah. You got your nest egg fired up there? I love it. Okay, cool. Let's do a review. We'll go through and make sure everything's accurate. A lot of normal mistakes people make in there, just because if you guys don't know that software, the planning software, we show it to you as if you're a financial advisor also. So you see all the geeky stuff and it's like, okay, don't let it distract you. Let's do the basic stuff first. Make sure we can trust the data. So oftentimes that's the best way to start. You heard a recession lasts 18 months. Do you think it started yet? Actually, tonight we'll go over that exactly. So we'll go over the duration. Is an 18-month recession normal? I think that's what you're asking. And long-term buy and hold, I don't see why on LTC. Why is now the moment in time? I don't want to participate in that. That's a tough one there. Recession video was good, a little scary. Those are the stats. I don't know. Now tonight, I got a lot of that feedback. So tonight I'm going to actually show, okay, it's not so scary. Let's look at the stock market's performance during those recessions, and some nasty recessions there as well. So we'll go through that, right? So it's not like, oh, the world's going to end. Yeah. All right, I will wrap it up there. Hope you learned something here today. Got a screenshot of the S&P returns there with the max drawdowns. And I'll see you tonight, right? Jazz After Dark. Go hang with me a little bit. Yeah, we'll see you then.